let's talk about something that most investors completely overlook. While everyone is busy chasing $300 AI stocks and $500 mega cap names, the real asymmetric opportunities, the ones that can potentially 5x or even 10x, are often sitting quietly under $10. February 2026 could mark a major turning point for small cap and cheap stocks. We're seeing a clear rotation into higher risk assets, improving sentiment around small caps, and strong momentum building in specific sectors like nuclear energy, EV infrastructure, biotech, and turnaround growth plays. This is a must-watch if you're serious about high-risk, high-reward investing, because the stocks we're covering today are real companies trading under $10, with genuine catalysts and significant upside potential. Before we dive in, a quick favor: if you appreciate deep small-cap research without hype or nonsense, please hit the like button and help this video reach 500 likes. And if you haven't already, make sure to subscribe and turn on the bell notification. When cheap stocks start running, timing matters. Now, very important, I'm not a financial advisor, and this is not financial advice. Penny stocks and small cap stocks are highly volatile and risky. You must do your own research and only invest money you can afford to lose. Let's get into it. First up is UR Energy, NYSE American URG. As of early 2026, UR Energy has been trading in the $1 range, firmly placing it in cheap stock territory. But this is no random shell company. It's a US-based uranium producer. Uranium matters right now because nuclear energy is back in the global spotlight. Countries are racing to secure domestic energy supplies, and the United States has been actively discussing ways to reduce reliance on foreign uranium imports. When governments prioritize domestic supply chains, smaller U.S. uranium producers like UR Energy suddenly become strategic assets. The company operates the Lost Creek project in Wyoming and already has production capabilities in place. It's not just an exploration story, it's an operating company. With a small market cap, volatility is high, but so is the upside if uranium prices remain elevated. The uranium spot price has been strong compared to previous years, and continued sector momentum plus fresh capital inflows into nuclear plays could send a stock like URG moving quickly. Next is Blink Charging Co., NASDAQ, BLNK. Blink has been trading under $10 and represents a compelling EV infrastructure growth story. The EV market isn't just about car makers like Tesla, it's also about the critical infrastructure needed to support them. Charging stations will determine how efficiently EV adoption scales. Blink builds, owns, and operates EV charging equipment and has steadily expanded its network across the United States and internationally. While revenue has grown, profitability remains a challenge, which is typical for growth stage infrastructure companies. At under $10, much of the pessimism is already priced in. If revenue growth stabilizes and losses start to narrow, the valuation could re-rate sharply. Government clean energy incentives are still in place, and any acceleration in federal or state-level EV initiatives in 2026 could trigger a fresh wave of interest in infrastructure names like Blink. Third on the list is Rocket Lab USA, NASDAQ RKLB. Trading under $10, Rocket Lab operates in the fast-growing space launch and aerospace sector. This is not a meme stock. It's a legitimate aerospace company providing launch services for small satellites. The space industry continues to expand, driven by satellite deployments, defense contracts, and private sector innovation. Rocket Lab has successfully completed multiple launches and is developing its Neutron rocket program. Its market cap remains far below that of the big aerospace players, leaving plenty of room for growth. If the company secures additional government or defense contracts, revenue acceleration could dramatically shift investor perception. Space is a long-term theme, and when speculative sentiment returns, space stocks like RKLB can move very aggressively. Fourth is SoFi Technologies, NASDAQ SoFi. SoFi has also traded under $10 and offers exposure to a genuine fintech growth story. Unlike many speculative cheap stocks, SoFi already generates significant revenue and has built a broad product ecosystem covering lending, banking, investing, and other financial services. The key for SoFi is continued progress toward consistent profitability and improving margins. If it keeps moving in that direction, the market may start valuing it more like an established financial institution rather than a high-risk startup. Interest rate trends will also play a role. If rates stabilize, loan growth becomes more predictable. SoFi's strong user growth and cross-selling opportunities across its ecosystem add to its long-term potential. At under $10, it provides exposure to fintech innovation without the premium multiples seen in previous years. Fifth is Ocugen, NASDAQ OCGN. Trading under $5, Ocugen operates in the high-risk biotech space. Biotech is event-driven. Stocks move sharply on clinical data, regulatory updates, and partnerships. Ocugen is focused on gene therapies and ophthalmology-related treatments. The appeal of biotech stocks under $10 is simple. A small market cap combined with clinical success can create explosive upside. However, clinical setbacks can be equally devastating, which is why proper position sizing and risk tolerance are essential. The power of biotech lies in its asymmetry. If a therapy delivers positive trial results, institutional money can rush in quickly. Zooming out, why are stocks under $10 particularly attractive in February 2026? Small cap rotations tend to happen fast. When macro sentiment shifts toward risk on, capital often flows from large caps into mid caps and eventually into small caps. Cheap stocks usually move last, but when they do, they tend to move the hardest. These names don't need perfect fundamentals. They need improving narratives and confirmed catalysts. Whether it's energy security and uranium pricing for URG, policy support for BLNK, launch success and defense contracts for RKLB, profitability progress for SoFi, or clinical milestones for Ocugen, each has a story that could shift rapidly. That said, risk management is crucial. Stocks under $10 are volatile for good reason. They're small cap, sensitive to dilution, earnings misses, and macro pressures. You cannot treat them like blue chip stocks. Smart investors scale into positions gradually, manage exposure carefully, and accept that 20-30% pullbacks are normal. The goal isn't guessing the future perfectly, it's positioning ahead of catalysts while controlling downside risk. Remember, price alone doesn't determine value. A $2 stock can be overvalued, and a $200 stock can be undervalued. What truly matters is market cap relative to future growth potential, revenue trends, sector tailwinds, and upcoming catalysts. If even one of these stocks executes strongly in 2026, the upside from current levels could be substantial. But once again, I'm not a financial advisor, and this is not financial advice. Do your own research, read earnings reports, review SEC filings, and fully understand the risks. Now I want to hear from you in the comments. Which of these under $10 stocks do you think has the biggest upside potential? Which one do you consider too risky? Feel free to rank them. And if you want more in-depth small cap breakdowns like this, make sure to like the video, subscribe, and turn on notifications. Cheap stocks can be dangerous, but they can also be life-changing when approached with discipline. February 2026 could reward prepared investors. Stay disciplined, stay informed, and I'll see you in the next one.